Okay, let's get into chapter 3. Let me bring this up. There we go. Okay, so we're going to talk about chapter 3. Chapter 3 is the adjusting process. Okay. For those of you that haven't watched it yet, please watch the video on explaining the practice sheets for chapters 1 through 4. This is the next stage in that process. Okay, so let's talk about the adjusting process. Okay, there's two methods of accounting. The accrual method, it records the effect of cash transactions as it occurs. In other words, revenues are recorded when earned and expenses are recorded when incurred. And I've mentioned this, I know, a dozen times, but it's important, okay? We have to recognize these when they are incurred or earned, okay? Most businesses use the accrual method, all right, because it's the most up-to-date and the most accurate. Now, the cash basis accounting records only cash receipts and cash payments. It ignores receivables, payables, and depreciation. So in essence, your books aren't 100% accurate. They're not the most accurate that they could be because there's a lot of things that it's not taking into consideration. And somebody could buy something from you in 1 month and not pay you until the following month. So if you use the cash basis, then you're not even gonna know about it. It's not going to be recorded until the next month. And so now your first month is inaccurate. It's giving you an inaccurate picture of how your business is doing. So revenues are recognized when earned and expenses are recognized when incurred. Under a cash basis, revenues are recognized when cash is received and expenses recorded when cash is paid. This is not GAAP, okay? Generally accepted accounting principles does not recognize a cash basis accounting. So actual versus cash, specifically to revenue. Okay. Suppose a dentist performs a service and earns revenue on May 20th, 2023, okay, but did not collect cash until June 5th. Under the accrual basis, the business records the $1,000 of revenue on account on May 20th by debiting accounts on May 20th by debiting accounts receivable and crediting revenue. Okay, remember, we recognize revenue even though we haven't been paid for it yet. Under the cash basis, the business would record no revenue until the cash receipt, which is in the case would be on June 5th. As a result, the cash basis accounting never reports it from the customer. Cash basis accounting actually shows the revenue in the wrong accounting period. So that's why we don't want to use the cash basis. We use what we call an accrual basis, okay? Now, transactions, let's see. Transaction as a debit to an expense and a credit to accounts payable. In contrast, cash basis accounting. Okay, so under the cash basis, the company will recognize the cash June 3rd. Okay, kind of redundant. Let's keep going. The accounting period. This is something else I've kind of talked about, okay? Because businesses need to periodically report on their affairs, accountants slice time into small segments and prepare financial statements for specific periods, such as a month, a quarter, or a year, something that you've heard me talk about. The basic accounting period is 1 year. Now, keep in mind that you've got a calendar year and you've got a fiscal year, okay? They are not necessarily the same. Most people think that a year runs January 1st until December 31st, but some businesses, they don't run that way. For example, school districts. School districts run from June, I think it's the 1st of July till the end of June, because that's how their school year runs. So they don't want to have a new fiscal year, a new accounting year in the middle of a school year. They want it to be in the middle of the summer when there's no school. So it's generally a year, but you have to keep track. Is it a calendar year or is it a fiscal year? Okay. Now, interim periods, financial statements of less than 1 year, and you're going to see this all the time. Mostly places will do a monthly time frame, an interim period of a month. If you're really, really small, like a little bitty mom and pop shop, you might go quarterly, okay? Because you're not going to have big goals. You're not going to have big budgets. Then you might be able to get away with it on a quarterly basis. But for the most part, you're going to go on a monthly basis. And again, and I've explained this a little bit in the practice video, but the whole idea is you've got a budget, you've got projections, you've got forecasts. You need to know on regular intervals if you're hitting your goals or not, because if you wait too long, then you're not going to be able to right the ship. Okay. You're going to wait so long and find out that you're so far off course on hitting your goals that you can't correct it. There's nothing you're going to do. You're just going to miss them. Now, if you're a sole proprietor, that's your business. Okay. If you're working for somebody else, working for a company, that could be the end of your job if you wait too long and mismanage it by not looking at things soon enough. Okay. So this is very important. So financial statements, we're going to do those at least on a monthly basis for a medium to mid-sized company so that we know where we stand as far as the business is concerned. Now, this is called the revenue principle, okay? When do we record revenue? We're going to record it, as I've said, well, about 100 times, when it's actually earned, okay? There we go. It tells the accountant when to record revenue. In other words, when to make a journal entry for a revenue and the amount of the revenue to record. The revenue principle says to record revenue when it's been earned, but not before. Revenue has been earned when the business has delivered a good or service to the customer, okay? The company's done everything required by the sales agreement, whatever it is, and the earnings process is now complete. We have formally earned it. So the amount of revenue to record is the actual value of the item or the service that was transferred to the customer. Okay? The matching principle measures all expenses incurred during the accounting period. Matches the expenses against the revenues earned during the same period. Whoops, too far. What does all that mean? Okay, this is it. The matching principle guides accounting for expenses. Expenses like salaries, rent, utilities, advertising. All these assets are used up and liabilities are incurred in order to earn revenue. So the matching principle measures all the expenses incurred during the period and matches them against the revenues of that period. There's a natural link between some expenses and some revenues. Okay, for example, a company pays a commission to the salesperson who sells the services. Other expenses are not so easy to link to sales. Okay, that one would be commissions to the salespeople. For example, monthly rent expense occurs regardless of the revenues earned that month. Okay, so you can have variable expenses and you can have fixed expenses. Rent would be a fixed expense. Regardless of how much you sell, you're always going to have to pay rent. Whereas a variable expense would be the commission to the salesperson. The more he sells, the more you're going to pay him in commission, which means more expense. Okay, so you've got your variable and your fixed expenses. Now, the matching principle tells us to identify those expenses within a particular period, such as a month or a year. The business will record rent expense each month based on the rental agreement. Okay, so that's now earlier we talked about the dentist who, under a cash basis, did the work in 1 month but wasn't paid until the next month. That violates the matching principle. Time period concept. Okay, the time period concept. It requires that accounting information be reported at regular intervals. So owners need periodic reports on their businesses. The time period concept ensures that information is reported often. Okay. Accounts are updated at the end of each accounting period. Thus, the adjustments. Okay. That's what they're talking about. Those are the updates. So when we update these accounts, these are called adjustments, and we have to do adjusting entries. Okay, no cash is changing hands. That's the big thing here. No cash is changing hands. We're simply recognizing expenses and we're recognizing revenues. Okay, so adjusting entries assign revenues to the period when they are earned and expenses to the period when they are incurred. Adjusting entries also update the asset and liability accounts. Those are the only accounts, okay? The asset and liability accounts, okay, that's it. Adjustments are needed to properly measure net income on the income statement and assets and liabilities on the balance sheet. So if we don't do these adjustments, we are not going to accurately reflect the information on our financial statements. So we're going to assign revenues to the period they were earned, expenses to the period they were incurred. And we're going to this way we'll properly measure net income, assets, and liabilities. Okay. Some key rules. Okay, first of all, when you're doing adjusting entries, never, ever involve cash. As much as I drill this into people, for some reason, I always see people doing adjusting entries and they want to adjust cash. I think it's because they're not sure really where to go with it, so cash just makes sense to them. But do not ever use cash as an account when you're doing adjusting entries. It's either a revenue or an expense account. We're going to increase them. Okay. Increasing revenue is a credit. Increasing an expense is a debit. Those are the only ones we're going to do. And accrued means the amount must be recorded. So what are the types of adjusting entries that we're going to talk about? Well, we're going to talk about prepaid expenses, depreciation, accrued expenses, accrued revenues, and unearned revenues. And keep in mind, again, none of those involve cash. Okay, cash has already either been paid or received. So we don't have to include those in any of this. So prepaid expenses, let's start with these. Prepaid expenses are advance payments for expenses. For example, companies often make prepayments for rent, for insurance, supplies. Prepaid expenses are considered assets. They're not considered expenses because we haven't used them yet. Okay, once we use them, then they are considered expenses. Until then, they are considered assets. Okay. When the prepayment is used up, the used portion of the asset becomes an expense via an adjusting journal entry. Okay. So we're going to kind of use these up over time, not all at once. Like rent, for example, if I prepay 6 months, I'm only going to recognize 1 month each period for 6 months. I'm not going to recognize it all at once when it's fully paid up, just the portions that I've used, because that's the period that they were incurred. Okay. So here's a short exercise. Provides an example of how to adjust a prepaid expense. So a company prepays for 6 months of rent on April 1st. On that date, the asset account, we're going to call that prepaid rent. That's the name of the account, okay, because it is prepaid rent. It's going to be debited for the full amount. So let's say we paid $4,800 for prepaid rent. That's what we paid for 6 months rent, $4,800. I have to recognize this as an asset because I've received it and it's going to have a future value to me. And I paid cash. So that's the journal entry to pay for the prepaid rent. That's not the adjusting entry. That's the entry that I used to actually pay for the rent for 6 months. Okay. So prepaid rent for 6 months. There's the T account. Okay. On the T account, it shows a debit for $4,800. That's prepaid rent, $4,800. On my cash account, it would show a credit of $4,800. Okay. So let's keep going. Now, the adjusting entries are going to be made on April 30th. That's the end of the first month, because now at the end of that first month, I have used up 1 month's worth of prepaid rent. So at this time, 1 month of rent has expired. The $4,800 represented 6 months. So I'm going to take $4,800, divide it by the 6 months, and my rent is $800 a month. So now I'm going to record that $800 as an expense because that's the part that I used that month. That becomes an expense. Now remember, when I add to the expenses, it's a debit. So there's my rent expense for $800. Now my other entry is going to be to reduce prepaid rent. Now prepaid rent is an asset. To decrease an asset is a credit. So I'm going to have a credit to prepaid rent for $800. Okay. So now on 4/30, here's what it would look like when I post those amounts to their respective accounts. So I would go into the ledger and under prepaid rent, I would post 4/30, $800, and under rent expense, $800. Okay. So that's the prepaid rent. My balance for prepaid rent now is $4,000. And each month I'm going to do the exact same thing until that's totally gone. And then I would have 0 in the prepaid rent account. Depreciation. Now we're going to learn more about depreciation in an upcoming chapter. Okay. For now, we're just going to take it at its face value. Plant assets are long-lived, tangible assets used in the operation of a business. Examples: land, buildings, equipment, furniture, okay? As the business uses these assets, their value and their usefulness is going to decline. That's depreciation. The decline in usefulness is an expense, okay? That's considered an expense to our business. And accountants systematically spread the cost over its useful life. So if its useful life is 5 years, then we're going to take the depreciation and we're going to spread it out over 5 years. That's what its useful life is, okay? The only exception to this is land. Land does not depreciate. We do not depreciate land. We can depreciate everything else, the buildings, the equipment, furniture, vehicles. We can depreciate all of that stuff. We do not depreciate land, okay? When we do take depreciation, though, it's going to be an expense. Now, remember what we've been saying. Expense, to add to an expense, is going to be a debit. And when you're trying to think of what the account name is, what are we doing? Well, we're adjusting depreciation. So it's depreciation expense. Well, we're adjusting prepaid rent. So it's prepaid rent expense. When we do salaries, it's going to be salaries expense. And we're always going to debit those, okay? Now, the account that we would put this into on the other side of the equation is called accumulated depreciation. Accumulated depreciation works differently than some of the others do. The adjusting entry to record depreciation is debited to depreciation expense, credited to accumulated depreciation. Accumulated depreciation is what we call a contra asset account. The amount of depreciation is computed based on the depreciation method, which we'll talk about in a later chapter. I think it's 9. But the key here is accumulated depreciation we don't close that at the end of the month. That is going to stay on the books as long as we have the asset. So on the balance sheet, when we looked at that earlier, you noticed that it had the asset, plant equipment, and then the value of the plant equipment when it was brand new, less accumulated depreciation. That's this account right here. This account, we're going to keep adding to it every period. It's going to get bigger and bigger and bigger because technically that equipment or whatever the asset is depreciating more and more and more every day. So after one period, it's going to be 1 period's worth of depreciation. The book value will be whatever it is. The next period, it's depreciated even more. So now it's going to be less accumulated, and the word accumulated, we're going to keep accumulating depreciation until that item is fully depreciated. We don't get rid of the accumulated depreciation account until we get rid of the asset. So if I sell the equipment, if I sell the car, the van, whatever it is, then I will get rid of the accumulated depreciation account, but not until. So this one's going to stay with us, okay? That's why we call it a contra asset, because it has the opposite characteristics of what you would think it has of an asset, because it's going to be subtracted from the value of the asset, not added to it. Remember, an asset, when we add to it, is a debit. A contra asset, when we add to it, is a credit, because that is meant to offset the value of the asset account. So this is going to have the opposite properties. To add to accumulated depreciation is going to be a credit, okay? It holds the sum of all depreciation recorded on a plant asset. The book value is cost minus accumulated depreciation. Okay, so that's why that works the way it does. Accrued expenses. Accrued expenses incurred before the payment is made results in a liability. In other words, we've received something, but we haven't done our share yet. We haven't done our part. So that means that we owe, okay? So businesses often incur expenses before paying for them. The term accrued expenses refers to an expense of this type. Consider employees' salaries, for example. The salary expense grows as the employee works. So the expense is said to accrue. Another accrued expense is interest on a note payable. Okay. Interest accrues as time passes on the note. An accrued expense always creates a liability. Okay. Now, companies don't make weekly journal entries to accrue expenses. Instead, we wait until the end of the period, and then we make an adjusting entry to bring that period up to date for the financial statements. Okay. Now, as an example, take salaries, for example. Okay. When it comes to salaries, a lot of people are paid every 2 weeks. Well, if you have your 2 week salary period, the last week of the period and the first week of the next period, then that means that technically you're not going to get paid at the end of the existing period. You're not going to get paid until after the first week of the following period. So cash isn't going to exchange hands in that period. The accrual basis says that we have to recognize the portion that's been earned or incurred now. So that would mean that we have to recognize 1 week's worth of salary expense, even though we're not paying it until the following month when the 2 week pay period is over. Okay. So, and that also goes for interest. Now, interest expense is accruing each day the company has debt. Usually the interest is recorded when the payment is made. But like salaries, at the end of the period, any interest that's accrued has to be recorded. I might not be paying my interest on it in this period, but I've still accrued an interest expense that I have to record. Okay, so this is how we would do it. And again, what are we talking about? We're talking about interest. So what's the debit? Interest expense. Talking about salaries. What's the account? Salaries expense. Okay, so it's always going to be whatever we're talking about as the expense. Expenses are always debited when we increase them. So both of these adjusting entries are going to have an expense. In this case, it's interest or it's going to be salaries. Okay. Now, here's the funny part about it. We're not paying it yet. We're not going to pay it until sometime in the future. That means we technically owe it. Okay. So we've created a payable account. Now, the payable account is only going to be there until we finally pay off the interest or the salaries when they come up. But in the meantime, we've got to create a payable account to show that we've expensed interest and expensed salaries, but we haven't paid them. We still owe them. Okay, that hasn't changed. So we're going to create interest payable as an account, and we're going to create salaries payable as an account. So now we've got our two accounts: interest expense, interest payable, salaries expense, salaries payable. When we finally pay salaries in a week into the next period, because that'll be the end of the 2 week pay period, when we do finally pay the salaries, we would take and we would get rid of the salaries payable because we paid it. So we would get rid of salaries payable. When the interest comes due and we pay the interest, we'll get rid of the interest payable account because we don't owe it anymore. But those at least are on the books, and it acknowledges that we haven't paid them yet. Okay, so that's the importance of those. Now, accrued revenues are a little bit different. As we've just seen, expenses can occur before a company makes a cash payment for them, and that creates an accrued expense. Similarly, conversely, I like that word better, businesses can earn revenue before they receive the cash, okay? This calls for an accrued revenue. So in this particular case, somebody has paid us, given us something. We have not done our part yet, okay? So cash will be collected and a receivable account is going to be debited. Since revenue has been earned, the revenue account is credited. So what's going to happen is this. Accounts receivable will be debited and service revenue will be credited. And that's going to adjust any accrued revenue that we might have. Okay. Now we have unearned revenue. Some businesses collect cash from customers in advance of performing work, receiving cash before earning it. It creates a liability to perform work in the future called unearned revenue. The company owes a product or a service to the customer, or it owes the customer his or her money back. Okay. So this is also known as a deferred revenue. So unearned revenue is a liability. When the company receives the advance payment from a customer, cash is debited and unearned revenue is credited. The adjusting entry decreases unearned revenue and records revenue. So basically all we're doing is we're acknowledging that we owe somebody product, services, or whatever. And as we fulfill these obligations, we're going to take it from unearned and we're going to move it over to earned. And that's what the service revenue is. So this is unearned, this is earned. And that's all we're doing, okay? So we took in cash, but we didn't do the work. So we have a debit to cash and a credit to unearned revenue. I haven't earned it yet, but I received it. Now, when I do earn it, finally, I'm going to take it out of unearned and I'm going to simply move it to the earned account, which is service revenue. When you see just plain service revenue, that means it's already been earned. If you don't see the word unearned, then that means it's earned. You don't have to see that word. It's earned, okay? And that's all that adjustment is saying, hey, I've already done some of the work, so I'm going to move it over to here. So, summary of adjusting entries. To properly measure net income on the income statement, we have to make adjusting entries. Each adjusting entry affects a revenue or an expense. To update the balance sheet, each adjusting entry affects an asset or a liability. Here's a summary of what the adjusting entries were that we talked about. Okay, we had prepaid expense, depreciation, accrued expense, accrued revenue, and unearned revenue. And here are whether they're debits or credits. The debit for these is going to be an expense. The debit for revenue is going to be an asset account. And the unearned revenue is going to be a liability account. And it depends on what the asset is. That's what determines these two right here. What's the asset? What's the liability? Like in the liability, it was service revenue. Well, what if it was sales revenue? Then that's what the debit would have been for, okay? The credit is going to be an asset. Okay, in this case, it was prepaid rent. A contra asset account, accumulated depreciation, is a contra asset account. It has the opposite characteristics of an asset. Because it's being subtracted, it's going to offset that asset. Accrued expense is going to be a liability. Accrued revenues and unearned revenue are going to be revenue accounts. So we go in, and again, if you saw the video on the practice sheets from 1 through 4, you notice that there was 2 columns for adjusting entries. Once we do the adjusting entries, we have all new balances now in the ledger for whatever was adjusted. So we're going to go back in and we're going to do what we call an adjusted trial balance. This balance basically is going to reflect all of those adjustments. If we did them correctly, when we add up our new balances, they should all equal. So we're not going to add up the old balances from the first two columns. We're going to add up the balances in the third two columns. Okay, so we prepare it, it's prepared after the adjusting entries are posted. It's a useful step in preparing the financial statements because that's going to give us the final numbers that we need to fill out those financial statements. It often appears on the worksheet, which I explained in that video. And it's a tool that accountants use at the end of the period. They're talking about the worksheet. And again, the worksheet is an internal document only. Once you're done with it, you can throw it away, you can shred it, you can keep it, whatever you want to do with it. That is confidential information. It is not intended for everyone's eyes. It's not intended for outsiders, okay? So this is what the worksheet looks like up to this point, okay? So you'll notice I've got the trial balance here. Those have to add up. The adjustments are here. And notice how they have letters after them so you can easily find them on the other side. Because if there's a mistake and the adjustments don't equal, you need to find out where it is. Now, if the adjustments are equal, and the trial balance is equal, then theoretically, once I carry all the new balances over, then it should all be equal, okay? So I would take these two columns, combine them with these two columns, and that's how I come up with my new balances, okay? So there's the trial balance, the adjustments, and the adjusted trial balance. Financial statements, reports revenue and expenses. We've talked about all this stuff. The statement of owner's equity, we've talked about that a little bit, and the balance sheet. The worksheet is what helps us to do these. We simply take the information and we just move it to its proper columns. Again, look at that video, and I explained that all there. And that's how we get it to those particular columns, and then we put it right into the worksheets. I mean, the financial statements. Also, this is important, as I had mentioned before, we take service revenue up, and all of these numbers get carried over to the balance sheet columns. From revenue, the first revenue account down, all of these go to the income statement columns. Do not take these accounts and put them in the income statement columns. Also, do not take these and move them to the balance sheet columns. Your numbers are going to be off, okay? So we don't do that. Okay, notice on the income statement, this is what we've talked about before. We have our service revenue. We have our subtotals, which are all of the expense accounts. This is not the debit. This is not the credit. Okay, these are simply subtotals and totals. And then we total that. Service revenue minus expenses equals net income. All these numbers come from the worksheet. Statement of owner's equity. Again, this comes from the worksheet. We've got our balance for January 1. We know what our net income is because we just figured it out in the income statement. We add that, and our ending balance is the new figure, in this case, 11,300. Notice, January 1 to December 31st. That's a full year, okay, that they've done this one. and then the balance sheet. Now, everything from the balance sheet columns goes over to the balance sheet itself. So all these numbers, you don't have to guess. It's all on that worksheet. It's going to tell you where everything is. Okay? All you've got to do is copy it over. And that's the end of chapter 3. So take a look at the practice for 1 through 4 and see how that works. Watch the video for that one. And once we get done with chapter 4, we should be able to complete the entire process. Okay, that is all. Have a good day.